Okay, so what is the break-even point? The break-even point is the number of units you need to sell to cover all of your costs. So it's the point where your profit and loss is zero. Let me explain this a little bit. Whenever you start a business, there's already going to be expenses that have occurred before you even sell any units. So think about this. If you had a restaurant, obviously you need to pay expenses like insurance, rent, maybe some utilities. And some of these expenses are already going to be incurred before you sell any products or services. So a restaurant would have to pay rent at the beginning of the month, and they've already spent a certain amount of money, which means that in order to break even, you have to sell enough quantity where your revenue is equal to your expenses. So the break even point is the quantity you need to sell in order to cover all of your costs and where your profits are equal to zero. So why do we need to know about break even point? As entrepreneurs, as small business owners, it's important to help determine the levels of output, how many units to sell, and how long it's going to take for you to recuperate all of your costs. So you have to find ways to lower your break-even point so you sell less, and you can do so through lower costs or a higher profit per unit, which is also called contribution margin. So what this all means is you're trying to cover all of your expenses as fast as possible. So that means that you want to sell enough where you can fully break even and recuperate all of your costs. And this also affects pricing and marketing strategies as well. When you sell products and services, it's important to consider the price of the product, because if the price is too high, that means that you're going to be selling less. And if the price is too low, you're going to be selling too more. So you have to find that sweet spot in order to have the lowest break-even point and the highest potential for profit. Because once you've surpassed your break-even point, once you've made enough profit, to cover your costs, the rest is pure profit. The rest is money that you're going to take in. So you have to find a way to recuperate your costs, and then any point after that is going to be profit. So basically, we want to understand break evens, and we conduct analysis to determine what price and quantity to sell in order to recover costs and what is the optimal quantity. So in order to understand break-even analysis, we need to understand that there's two main types of expenses: variable and fixed. There's also mixed, but I'm going to save that a little bit later. But the two most important ones you need to understand are fixed and variable costs. Fixed costs are incurred because you have to pay them regardless of how many units you sell. You can sell 10 units, 50, 100, 150 units, and these costs are going to be the same. So you usually incur these costs at the beginning of the month, and they don't change or increase because of output or producing more. So for example, if you rent a place, it's going to be the same rent regardless of if you sell 5, 10, or 50 products. Variable costs are costs that will go up because of the output. So if you rent a restaurant or if you rent a bakery, the ingredients are going to be variable costs, because as you sell more of these products, that means you have to buy more flour, more sugar, more salt. So the actual product cost is the variable cost. Materials and some utilities are going to be variable costs, because the more you produce, the more you have to spend. So you have one fixed where it doesn't increase or decrease based on your output, and you have variable. So as you produce more and more and more and more and more, it's going to go up. So two costs, we have fixed and variable costs. All right, so in order to determine the break even in units, we need to figure out our fixed costs. So I'm going to give an example of a hot dog stand, another food example. So we have fixed costs of $1,000, and let's assume it's for 1 month. It covers the license, the rent, and the insurance. Now we sell hot dogs to customers for $3. And when we sell a hot dog to the customer for $3, we don't profit $3. We actually profit $3 less the cost of the actual sausage, the bread, and the actual ketchup and mustard. So those are the product cost. So every time I sell one hot dog, I'm actually making $2 in profit per unit. And we call this the contribution margin. As we sell more units, we're going to get $2 of profit each unit. So we have to figure out how many hot dogs we have to sell in order to cover the $1,000 of fixed costs. So we have 500 hot dogs and we make $2 profit each one. That means that 500 times 2, we're going to break even when we make 500, when we sell 500 hot dogs. So that is the break even. So right here we have $1,000 in fixed costs. We have 1,500 in total costs. So at 500, we're going to have the break-even point. So any point left of this side over here is going to be lost because we're spending all of the costs over here, the 1,000, this triangle over here, that's going to be our loss. If we sell 50 hot dogs, that means that we're going to have costs over here and we're not going to be able to break even because our revenue is over here and our costs are over here. So the blue line represents how much revenue we make by selling products, and the orange line represents the total cost, variable and fixed combined. So revenue, we sell this amount of revenue, and then our total costs are going to start at 1,000 because that's our fixed costs. $1,000 is our fixed costs, and it's going to be incurred regardless of if we sell 0 or 100 or 200 or 1,000 hot dogs. So it's going to stay the same. That means that we're going to start the total cost line over here, and our costs are $1 per hot dog. So that means that every time we sell 100 hot dogs, that means that we're going to have $100 of variable cost plus the $1,000 of fixed cost. So this is going to go up steadily, and our revenue is going to go up. So after this point, which is the break even, our revenue is more than our total costs. So this triangle right here represents the costs, and this triangle over here represents the potential profit we can make. So that means we need to sell 500 hot dogs to break even. If you're thinking like an entrepreneur, you're going to realize that you're going to have to calculate how many hot dogs you sell per day, per week. So if you sold 50 hot dogs a day, that means that in 10 days, you're going to fully break even. So you want to find ways to either sell more hot dogs or lower the cost in order to break even and really start to make profits. The sooner you get to this break even point, the sooner you can start to make these nice profits. So I thought it'd be nice to give you an example scenario that a business might encounter when you think about break-even points. So I have 5 prices over here, and these are product prices. We have 15, 10, 9, 8, and 7. And this is quantity demanded 2,500, 10,000, 13,000, 14,000, and 15,000. So as you can see here, the lower the price, the more people are willing to buy your products. So that means that at $7 for the price, you're going to be selling 15,000 products, or that's the demand. And the variable cost, I'm just going to use the assumption of $5 for your variable cost. So that means that every time you sell one product, immediately $5 goes to the actual product, and depending on the price over here, this can affect your profit. So if we sold a product that's $15 and the variable cost is $5, that means our contribution margin is $10. It's your price minus your variable cost. Same over here. $10 price, $5 variable cost, $5 is your contribution margin. $4 is your contribution margin when you have a price of 9 subtracted by $5 of variable cost. So the contribution margins are 10, 5, 4, 3, and 2. So the lower the price, that means that you're going to get less profit per unit, but you're also going to sell more. So as an entrepreneur, you have to find the sweet spot, the price that's going to get you the most revenue. So this is the revenue column. All we have to do is multiply the price by the quantity demanded by the customers. So if the price is $15 per unit and we sell 2,500 units, that means that we make a total of 37,500. But that's not our profit because this is only our revenue, and we have fixed costs of 40,000, and before we even sell one unit, we already have 40,000 in our fixed costs. So that means that we need to find a way to recuperate this 40,000, and the profit per unit is going to be dependent on the price and the variable cost. So at a variable cost of $5, we need to sell above $5 in order to make profit. If we were to sell at $4, that means that for every unit we sell, we're losing $1. So this is our total cost, and we get our total profit when we calculate it through revenue minus your total cost, and it's going to be equal to your profit. So in this case, we don't even cover our fixed costs. This business should shut down if it's going to charge a price of 15 and you're going to sell 2,500 because we're not making any money here. So in this case, the break-even point is 4,000. How you calculate this is you have your fixed costs, 40,000, divided by your contribution margin, or the price per unit minus the variable cost per unit. And the variable cost is the actual product cost. So it's $15 minus 5, which is $10 for your contribution margin. 40,000 divided by 10 is 4,000. So here are the calculations here. I just put this into a fancy Excel spreadsheet, and you have your price, your quantity, and this was easy. All I did was equals, and I did this cell minus this cell, and I sort of dragged it down. If you can drag it down, the formulas go down. So we maximize our revenue at this third option here. So if this business were to choose a price to sell at, it should sell at $9 price, 13,000 in your quantity, and you have 40,000 in fixed cost, and this fixed cost is the same. So as I mentioned, if you sell 2,500, 10,000, 13,000, this fixed cost is going to stay the same. The variable cost will go up because as you sell more products, you're going to need to buy more of the product materials and supplies. So 2,500 times 5 is 12,500. 10,000 times 5 is 50,000. So this variable cost is going to go up, the fixed cost is going to stay the same, and this is going to be the total cost over here. So we make the most profit at revenue minus your total cost. And the break even, so is right here. We get lower break evens at the higher price, but if you look at it this way, we're not making enough because the customers don't want to pay $15 for the products. They only want to pay a certain price where they feel it is quite valuable. So they want to pay the lower price, but the suppliers want to sell at a higher price. So it's a little bit of give and take here. So even though the higher price equals to a lower break even, that doesn't mean that your customers are going to actually buy your products because the price over here might be a little bit too high. So at 10,000 units is going to be the profit 10,000. Okay, so higher the price means that it takes less time to get to your break even, but you also have to make sure that your customers are willing to pay that price because at $15, only 2,500 quantity was actually sold. So this is the total cost, which is equal to your fixed cost of 40,000 minus the product cost of 5 times the actual quantity. Okay, hope that gives you a little bit of insight into break even. It's a great way to sort of analyze how we can calculate the number of units to sell where your revenues are equal to your expenses. And if you think like an entrepreneur, how long is it going to take for us to break even? If it's taking us a long time to break even, we need to find a way to increase your demand. We need to find a way to increase the revenue or lower your expenses so that you can have more profit per unit, which is the contribution margin. So I hope you enjoyed today's video. Make sure to give a thumbs up, give me some feedback in the comments. And I enjoy making these videos. So I hope to see you again soon. And the next video I'm going to make is going to be on the accounting equation. So debits, probably not debits and credits, but assets, liabilities, and equity. And maybe we'll get into balance sheets a little bit. So thank you for watching, and I will see you later, okay? Bye-bye.